All right, now just as markets have finally started to shrug off their bearish trends, we are looking at a Morgan Stanley report. This report has sounded some warning bells for the Indian economy. According to it, the central bank is going to resume rate hikes if Brent crude oil levels rise and stay above $110 per barrel. Remember, the MPC hiked interest rates by 250 basis points between May 2022 and February of this year. And this, of course, in a bid to combat rising inflation. So this report says that a $10 increase in oil prices would give a boost to inflation by around 50 basis points. It contributes to a 30 basis point widening in the current account balance as well. So will higher crude oil prices derail the revival that we are seeing in the Indian markets and the Indian economy? Let's discuss this on India Tonight. And for that, Shogda Bhattacharya, independent economist, joining us on the show. Shogda Bhattacharya, always a pleasure getting in your views. Now, if crude prices rise or remain at these elevated levels, what are the chances you think that this is going to derail India's economy, like this note from Morgan Stanley is suggesting? Will this prove to be India's Achilles heel at a time that we have a rather stable and a rather firm-footed economy?
So first, Vikram, thank you for having me on your show. In the hypothetical case that crude Brent prices persist above $110 a barrel, which leads to the current account increase, the widening of the current account deficit, an increase in inflation, etc. So there might be a case for a monetary policy response, a hike in the policy repo rate. But my argument is that probably this case will not probably need to arise. Number one, global oil markets definitely remain tight. The supply cuts by the OPEC plus, etc., low inventories. But together with this, there are already major signs that despite an increase in activity and import demand from China, Brazil, India of oil, there are signs of a major weakness developing in the US. Europe, as you know, particularly Germany, is already in a relatively bad shape. And US macro indicators do suggest that there is a weakening there. So that demand balances out between the different geographies. Secondly, if oil were indeed, due to some geopolitical shock or whatever, rise to $110 a barrel, that itself, as you mentioned, will have a very major braking effect on developed markets and thereby from the trade side, etc., on into emerging markets, including India. So that itself is an inherent braking effect of a high crude price. Thirdly, for India, for a country like India, where oil markets are not completely free, fuel pump prices are not transferred based on the cost of crude. My response would be that rather than use a blunt monetary policy tool, it's always better to use alternative tools, particularly fiscal. So in other words, direct subsidies or indirect subsidies to the oil marketing companies to not pass on the rate increases. I think that's the appropriate response. Only if it's not just oil, but a series of multiple overlapping shocks, as the Monetary Policy Committee had mentioned in the last instance. So El Nino conditions leading to a rise in food prices, the Chinese recovery leading to an increase in metals prices, etc. Only in that event, with core prices increasing, might there be a case for a monetary policy response, including a repo policy rate hike to oil prices sustaining about $110 a barrel.
Right. So as far as the RBI is concerned, right now we've seen inflation above the 4% midpoint of the RBI's target band, and 4 times in a row now, Shogda Bhattacharya, we've seen the RBI keep those interest rates unchanged. The tone has been hawkish, of course, but now, what do you think the RBI is going to have top of mind to move those interest rates, if at all, if crude oil prices, like you're saying, and it is very hypothetical, that it could go higher or stay at elevated levels? Do you see these interest rate hikes coming in anytime soon? And if so, do you think there could be a gradual rise? At this point in time, where would you put your bets on?
So my bet is in the immediate future, the next 2-3 policy meetings, I don't think, even if oil rises, they will wait to see what kind of impact will it have directly on inflation and indirectly on the rupee, as you mentioned at the beginning, because that's a worry, that if in case the Fed decides to hike interest rates in response to higher oil prices. My own bet is they will not. That the Fed is more or less done with its rate hikes. The European Central Bank is definitely done. So I think from my bets, they are not going to face a very high increasing return from increasing rate increases from the developed markets. So that will give them. But anyway, if the current account deficit begins to deteriorate, that might put a pressure on the rupee. In case this pressure is only due to a hardening dollar, US dollar, which is what we have seen in the past, that in case a prospective depreciation of the Indian rupee against the dollar, that might lead to them letting go of interventions, and that might possibly as you saw in the OMO announcement in the last policy, they might try to use higher interest rates to stem the dollar. Even there, I don't think that will be probably likely a last resort. They will first use liquidity measures, then they will use other tools to try to control the currency. If nothing else works, and the dollar keeps on rising because of a safe haven currency effect, etc., only then would the RBI resort to use interest rates. And I certainly don't see that happening in the near future.
See any immediate threats to our current account deficit and the kind of pressure this would put on the value of the Indian rupee?
So there is a threat. So suppose in the hypothetical case, as we are discussing, that oil does indeed go to $110 a barrel, that will have an impact on oil. But now we have additional alternative sources of oil, say from not just Russia, but even from Venezuela, that we have been seeing. That discounted oil from Venezuela and from Russia. So that might blunt the effect to a certain extent of a rise in Brent crude prices. But otherwise, I mean, if for whatever reason oil prices remain at high levels, 110, 115, 120, etc., that will definitely have a very deleterious effect on the current account deficit, including indirectly on the rupee. And that might lead to be, I mean, having been forced to lead. But even there, the first response to my mind will be the fiscal response. So either subsidies to the oil marketing companies or the oil marketing companies bearing the shock and not being able to transfer dividends to the government, which is an indirect subsidy that the government will provide to the oil marketing companies. So that's the first line of defense. If that doesn't work, so we are ratcheting up the impact so more and more graver and graver cases for our currency, for our current account deficit, etc., and inflation, particularly core inflation. That's the point where monetary policy will begin to kick in, a further tightening of monetary policy, including a hike in rates. But even if monetary policy were being used, my first bet is they will try to control liquidity, which anyway, they will probably face a tightening of liquidity, because if the RBI begins to defend a weakening rupee, so that will extract domestic liquidity from the system. That will immediately have an effect of tightening liquidity. So that will probably be the first indirect monetary policy action before the RBI and MPC resort to increasing the repo rate.
Hike in interest rates would come later. At first level, the first response you think would be on the fiscal front. So in toto, in your assessment, what do you see as the biggest risks right now to the Indian economy that would really hurt the financial markets as well? Perhaps uncertainty on the political front is something else that we are hearing as well that has been flagged off. Do you see that possibility also put stress on the economy?
So from the domestic front, I'm not a political scientist, so it's very difficult to take a call, but that risk definitely remains, that there is some political instability. I think it's a relatively remote risk in a general election level, but I mean, you need to be cognizant of that risk. I think the biggest risks to the Indian economy are now external. One, of course, I mean, there's that overlying, the overarching geopolitical strains now from the Middle East, in addition to Ukraine, maybe other fronts will begin to open up. So that's the biggest stress. The second one is from overseas offshore monetary policy tightening. So if the US tightens even further, as we began to our conversation, that the hypothesis that the Fed might be forced to hike rates. So there are financial sector instability issues begin to come to the fore. There are some banks begin to display signs of stress, etc. So that will lead to an outflow of currency from India, quite apart from the current account deficit or anything else for that matter. So that. And in addition to that, this might get aggravated, exacerbated, if due to all these actions, the global economic growth, which is already forecast to slow down, that slows down even further. So that via the current account deficit, in other words, our exports, via that channel, and then thereafter capital outflows from the country. I think that's the external risks, external shocks are the biggest risks that we now see to the Indian economy. Over in the domestic economy, as you heard before from other analysts, the domestic demand remains very resilient. And other factors, I mean, inflation is beginning to come down. I mean, it's not going to go to, as the RBI forecasts also show, it's not going to go to 4% in the immediate future, but it's likely to remain within the 2 to 6% band. So
Right.
I think the domestic economic conditions are resilient, but the risks are external.
Global shocks is something that we need to be more wary about. And this is hypothetical context that we are adding perspective on, but we'll see exactly how crude oil prices pan out from here, and something that we're watching very closely. Thanks very much, Saugata Bhattacharya, for joining us with your perspective tonight on
Thank
this
you so
edition.
much, Vikram. Thank you.
Always a pleasure.